I'm very excited I get to do this with the group of people that we have. I've learned things every time. I'll be sitting at the table when they're speaking, taking notes. They've saved me money. They've helped me direct my estate, so I'm excited about that. This is a new presentation. We just put it together yesterday. We created a new trustee investment book. Everyone live has been given one of those, and there'll be some references to that. So basically, my company, the Norris Group, does a number of things. We buy properties. We buy about 100 properties a year, fix them up and resell them. We do loans for other investors that do the same. So about 35 times a month or 400 plus a year, people find a deal, we finance it and become their lender. They either fix it and resell it, or they keep it as a rental. And we'll talk about those kinds of programs in our trust deeds. When you're loaning about 400 times a year, we have a lot of people's money involved in trust deeds. So we have investors that want to buy properties and deal with real estate. We have a whole other group of investors that don't want that hassle. They just want the cash flow from the trust deeds and become the lender. And so that's kind of what we're going to talk about this morning. And then we teach other investors. So this year we've had several events with over 450 people attending them. And we teach investors what to do in a very specific market. This year, most of our deals have transitioned from REOs to short sales to buying directly from people, and we teach them how to do that. And so our business has boomed this year. In the last 4 or 5 months, we've funded upwards of $7 million in a month. And so we're very busy, even though you might hear that there's not much inventory to buy. Our people are skilled and they can find it, and they've been doing so with regularity. We have a radio show that you might want to go to our website. You can listen to any one of hundreds of interviews, and the intent of the radio show is to interview somebody that's in our industry that has influence and knowledge. Leslie Appleton Young was one of the more recent interviews, where we talked to the chief economist of California Association of Realtors and her thoughts about what was going on in the realtor world. We just had a panel at the Nixon Library where we had leaders from various, like Mortgage Bankers Association, the Builders Consultant, John Burns, and that was a great evening. Some of the people that are here tonight or today were at that event. So we're constantly trying to educate. In that radio show, you can go to online and get any one of many hundreds at this point. Our basic business model has always been taking this lovely house and turning it into that house. So when we touch a house, can you imagine if you lived next door to that? You'd be pretty happy an investor showed up and turned it into that. And so that's what our investors do. We fix up houses, and half the time, let's say, we resell them, and the other times we keep them as rentals. Either way, the neighborhood's improved. The odd thing about the financing world as it's evolved over the last few years is that the investor is really not been treated very generously with typical financing, conventional financing. So more and more often they've gone to financing that is privately funded. And so that brings about opportunities for us as we are in the hard money loan business, and as you might be interested in investing in trust deeds. One of the things that has happened since I've been involved in real estate is the changing of interest rates. So in the beginning, when I started to buy real estate, it was 1980, 81, we were at the peak of that chart. I remember being wanting to be an investor, and I had almost a free and clear home with a 5% mortgage on it, and I refinanced it in 1981 at 17.5% fixed, so I could create the seed money. I remember I borrowed something like $72,000, and my payment was $1,362. Now, back then, we rewarded savers, and we were able to get, obviously, a very big yield on whatever we had money-wise, even in a 10-year T-bill. That chart has changed over the years to where now if you're a saver and you don't have an alternative place to put your money and you just know how to buy a T-bill, then you're not very happy with the yield. And so that's changed a great deal. Who gets rewarded? Before it was the savers, now it's more of the person that can use leverage. And so our real estate investors know how to do that. That chart is ticked up. Everybody's concerned. Real estate interest rates, you see the article, real estate interest rates are way up. Come on, look at this chart. Yeah, they're way up to historic lows except for last year. So this is not a very threatening chart to me. So it's kind of exciting to be in a market that has an interest rate that starts with a 4. You know, we were lucky, of course, they had started with a 3 before, but 4 is not bad. This is an important chart to me because as I try to figure out what's next for our industry and for our business, this affordability chart tells me where we are as far as a history of, is this a bearable payment? And so you hear a lot of people say that, okay, prices have run up and affordability is declining. Is that a correct statement? Yes, affordability has declined. We've gone from the mid-50s all the way down to 36%. So is that a catastrophe? Well, if you take a look at the history of this chart, it's rare that we're over 40%. All of the 90s, 93, 4, 5, 6, 7, 8, 9, very close to 39 or 40% affordability. We've had this good price run in the last 12 to 18 months. We've had an interest rate hike, and that's reflected in this chart at 36% affordability. What this chart means is that going forward, you're probably going to have another repetitive pattern. Now, what's repetitive about this chart is where California prices will stop. If you take a look at 1980, 1989, and we're going to use 2005 as the stopping point where it should have stopped, they're repetitive in the nature that they stop at 17%. One of the things in my studies about statistics is there's a participant called a human being. And this is what we're likely to do. We're likely to buy more real estate as prices go up than when they're lying flat on their back. That's just what we do. So if you look at the volume of sales, it goes up as affordability goes down. And everyone's participation goes up. The owner-occupant, the investor that's local, and the foreign investor all buy more per category as prices accelerate. That's what we do. So we all drink the same Kool-Aid. So this affordability chart is standing where it stood in between 2000 and 1999. So literally what we have in front of us is the same potential price increase and interest rate hike absorbability as we did in 1999-2000. If you remember, if you thought year 2000 was a good time to sell your stuff, then you should sell now, because that way you'll miss anything that goes on between 2000 and 2005. That's about what's going to occur now. Now, we're going to have interest rate hikes probably during that time period, but we still have plenty of room for prices to run, and this affordability is how you'd know that's true. What's very interesting right now is our inventory is already down to levels that usually allow for prices to increase considerably. So this inventory mix has also gotten healthier. When we were looking at that big chart way up in 2007 and 8, it was a mix of 50% to 70% lender-owned properties, depending where you lived. Now it's what's selling in California is about 85% equity sellers, people like you and me that decide to sell. They want to move to another neighborhood. So it's a much healthier mix. Even in counties like Riverside and San Bernardino that had 60 and 70% either REO or short sale is now a much healthier mix. When you get where it's mostly an equity seller that's participating, first of all, it's very difficult to go up in inventory. So there's a thought that, okay, all these people now that are coming and getting their head above water after coming out from being underwater, they're going to sell their home and they're going to be a renter. And I've thought about that, and I just think there's no way. If anybody's proved that they really like to be a homeowner and occupy their own space, it's the person that paid payments while they were upside down for 5 or 6 years, and now they finally have equity. Do you really think the bulk of them are going to sell so they can be a renter? There's no way. Now, they may be happy they can relocate, but I would bet that they would be buying something else. So when you have the bulk of your market being an equity seller, as soon as an equity seller sells something, guess what they become? A buyer. They buy something else. So this chart is going to have a very hard time going back up. Now, you don't have 3 months of demand in the California market. Because look at this chart. It went down from 6.5 months in the last 2 years to 3 months because of demand. You still have all that demand, and every once in a while they do something to enhance demand. A few months ago they said, okay, everyone that's had a bankruptcy, a foreclosure, or a short sale, we used to make you wait 3 years before you're a buyer. Now you can buy in 1 year. So you just took all the people that were going to have to wait until 2015 and 2014 and shoved them into right now, on top of 3 months of inventory, when there's normally a 6-month inventory would be what we would call equilibrium. So we have really a shortage of inventory, a lot of buyers. We're all concerned a little bit about this temporary low in prices. To me, I look at long-term trends. Can you have prices stagnant when you have 6 months demand plus and 3 months of inventory? The odds are no. That won't stay that way. And it's never has. So I would think that prices are going to continue to accelerate, and typically they accelerate until we get down to affordability number that's very common. For the investor that trying to get financing, if you want to get past the 10th loan, it's not doable. If you try to, I don't care what your FICO score is. I hadn't pulled up my credit for a long time, and I finally got a couple of loans on some rentals, and forever I had a hard time having a FICO score over 740, and I couldn't understand it because I never had missed a payment in my life. The problem is I didn't have payments. I figured that out. So I got a couple of loans earlier this year, and my FICO score went over 800 simply because I had 2 payments to make. So if you own stuff free and clear for a long time, which I have since '05, it's like you never had credit. Isn't that strange? Now they feel the system feels better now that I owe some money. I said, okay. Somebody should give you an instruction booklet on how to have a really good FICO score, and I know people have actually done that. So when an investor is in our business and they're buying and selling properties for a living, 10 loans is really not very much, because if you have inventory, and we know this is true, we usually have loans in place for 5 to 6 months if somebody's doing a rehab. So if you're going to have a business, you're going to always have a number of properties at the same time. If you're full-time, you're going to pass 10 loans all the time in a year's time, and you can't get financing. The other thing the conventional world doesn't like is they don't like homes that are messed up at all. And remember that picture in the beginning? That's what we deal with. We deal with homes that have problems, so we can buy them at a discount and fix them. And so the answer really is the private funding world, and that's what we've been able to fund for our investors, that type of loan, for a long time now, going since 1996. There are other types of investments, and I've got to say that I'm really glad I'm not involved in any of these. I don't like a T-bill because of the yield. I don't like the stock market because of the volatility. I don't enjoy that. Now, you guys might have a lot of money in that, but first of all, I don't know really how to figure out if the company's telling me the truth anymore. I don't know if the CEO is going to get put in jail on Saturday. That bothers me. I've had that happen. I've owned stocks on Friday and have the CEO put in jail for fraud, and my stock value disappeared by 50% on Monday, and I didn't do anything wrong. I just picked the wrong company, but the truth is I didn't know why I picked the company in the first place. Maybe a broker recommended it. I am completely out of that world. The other thing that isn't a match for me is I do not like watching what my stuff is worth every day or literally every minute. You have a stock, you can go over there on the screen and go, oh, I don't enjoy that. I'm glad my houses don't have a ticker tape on the yard, you know. It's really boring, and I kind of like that. Bonds, It's not something I know. So I landed in a space that I'm comfortable with. And trust deeds is that, plus rental ownership for me. Most of the people, and apparently lots of them, 96% like the cash flow of a trust deed. On our trust deeds, there's monthly payments. We know that there are other trust deeds out there that say, okay, you can have like a moratorium for 6 months or a year, and then it's all due at the end. We know that's a mistake. And apparently you like the monthly cash flow too. But we also, because we collect monthly payments, we know when somebody has a problem right away. So if they don't make a monthly payment, their world is messed up. And we have a notice within 30 days that that's true. Can you imagine how much trouble you can get yourself in if you had no payments on all the real estate loans you could get in a year? You know, at the end of 12 months, it might be a very different circumstance. So that doesn't happen. The security of the loans that we have is that you will be on the trust deed as a lender. We've decided as a business model we don't do pools. Pools work really good until they don't. And that's the scary day. So you think everything is going along fine, you're getting your monthly payments, and then all of a sudden you don't, and then you find out, and we've all heard those news articles where, I just heard it yesterday, somebody just got indicted, and it was a gigantic pile of millions of dollars in Orange County, and it was a pooled investment, and it went bad. But you don't know that because you keep getting your payments, so you think everything is fine. We just decided not to do that. So when you're on a trust deed, you're the lender, and you have the control. Trust deeds is a way to diversify within the real estate family. So it's this is Aaron's term, real estate without tenants or toilets. And there is a difference. I was on a cruise one time. I came back to find out that Riverside had sort of a mini tornado and took out about 100 feet of one of my rentals. And so $2,000 later, I fixed the fence. Now, had I had a trust deed on that house, guess what would happen? Nothing. I wouldn't have even known because I would have just gotten my interest check, and whoever owned the property would have fixed it. And that's the difference. Another way of diversifying is when you have trust deeds, you have more than one. So you have a trust deed on this property and this property and this property. And so in a way, that's diversification. We understand California's trends, and so we always watch when to back off of being aggressive in the California market, when to change programs, and so we're on top of all of those things. I like trust deeds because most people can understand it. If you've ever borrowed money against real estate, you know what a first trust deed is. When you're an investor in a trust deed, you're the bank. I get it. It's very simple for me to understand. I like that you can visit the asset. Most of our investors in trust deeds don't go see the homes anymore because they know that we do. It goes through a process for us to loan on the property, and part of that process will be an appraisal. And so our team of experts looks at that loan from an underwriting standpoint, also from a physical standpoint. And the person that sees that property is a whole lot more experienced than you are. And if they see something wrong, we're going to get told by them, I wouldn't do that loan. Our loans always have money that's necessary to put up by the borrower. So sometimes you hear hard money lenders get up and say, okay, we loan to you, no credits necessary, no down payments necessary. Well, that's not our client. Our client is going to have money into it, and that's every time. So skin in the game is an important factor. And also we know that important factor is having money behind that transaction. So it's not just that you have money into it. We want you to have money behind it. We're very experienced in this business. Anything ever go wrong with one of your projects? Every time. There's always surprises, and you better have some money behind each of those homes, and we demand that. The type of borrower that we loan to has a profit motive. And so we're not loaning to somebody, and we'll talk a little bit about the idea of not loaning to an owner-occupant. But this is a business owner. We're basically a business lender. And so someone that borrows from us is going to come back over and over and over again. And how they would stop access to that is mess up on a loan. So you can't have like a loan that's 3 months behind and then come to us and say, well, I'd like to borrow money on this new project. This is going to work out. No. Go make this one work first. Tell us about your next one when this is paid off, because you've just messed up. So because they have a profit motive, they want to stay in good graces with us as well. I like that I understand the worst case scenario of having a trust deed, especially one that starts at about 65% of value. Any investor in this room that tries to find deals right now, if you said, would you like to buy a house at 65 cents on the dollar? It would almost be sight unseen because they're very difficult to find. That's the position that you will start at approximately in a trust deed, at 65% of value. And so your worst case scenario is you pay for the cost of a foreclosure and you own the property. The odds of that happening are way less than 1 in 100 in our company. So it's very, very rare. And normally what would happen at a trustee sale is that you would add what you're owed on the trust deed plus back payments plus any fees that you've had to pay out, and that would be the starting bid. And in this market, trustee sales are going for about 90% of value. So it would be hard for you not to get paid off at the trustee sale, would be my guess. And if you had to become owner of that rental, what happens is that you have such a discount to price, and you had been used to one cash flow stream at an interest rate. Usually the rents far exceed the monthly payment that you were getting as a lender. So you basically just swap seats with an equity position. Now, I don't know about you, but I like that that's the worst case scenario. I can live with that. We have a number of different programs, and one of them is that has gotten popular is a 9.9% loan. This used to be an 8-year program, but because we know that we'll peak out in price before 8 years at this point, we've cut it down to 5 years. It's an interest-only payment, as all of our loans are, and the starting point of this loan is between 60 and 70% loan-to-value. The loan-to-value changes with our experience with the borrower. So if we have somebody that's paid us for years on every loan, then we know we can be a little bit more aggressive with that borrower. So how they've treated us in the past tells us what we will do with them in the future. We've had no defaults in that program, well over 200 loans in place, over $20 million funded in just this program alone. So this has turned out to be a good program for our investors. This would be a typical example. In the desert, this might be the landscaping that you'll see. And if that bothers you, I don't know what to say. Sometimes that's going to be the landscaping. What wouldn't bother you is that at the time this was worth $67,000. Then when we did this loan, we lent $40,000 on the property. The investor was getting $300 a month. And I would bet the rent, there's the rent, over $1,000. So once again, if you had to foreclose on the property, you'd foreclose on an asset that's worth more than your trust deed, and you change from a $300 check to getting a $1,000 rent check minus expenses. Would all investments have such a small downside? And one that we can understand. And by the way, at this time when this loan was done, we probably had this value of the property at one time was probably close to 150 at the peak of the market or more. So we were being able to loan against properties at pennies on the dollar compared to their former value. This is a 2-bedroom, 2-bath. Most of the properties that we loan on are single families. Occasionally we have 2 to 3 or 4 units, but we don't loan on commercial or mobile homes or that type of product or land. So it's pretty boring what we do. This is another house. This is in LA, value at $261, trust deed at $170 at 65%. Payment to the investor who put up money for the trust deed is $1,558. This was done for 8 years as an example. Doesn't have the rent in here, but I would imagine in LA it's over $2,000. Now we also do construction loans. So this is a beautiful home being constructed in Rancho Mirage. The value is over $1 million. The loan amount is $530,000. Construction loans are going to be an additional part of the loans that are available. Since I'm very comfortable with this process, and that's another thing, our team has done this. We have general contractors that work for our company So if something went wrong, we would be able to pick up where somebody left off and take care of the project and get it finished. When you rehab 100 houses, you've seen everything that's about to see, 100 houses a year, you've seen everything you're going to see fixing a home. So constructing a new one's not that difficult. This loan is $530,000. I'm really familiar with this loan because I put up the money for it. So I'm very comfortable with construction loans. When somebody gets a construction loan, they have to own the land free and clear. So whoever has this project has put up about $200,000 plus before I put up a dime. That's kind of your assurance that they're going to stick around. Now, they're always ahead of the money that we let out. We just don't hand them a $530,000 check and say, I sure hope you get done. What we do is we follow their progress, and as they're done with a certain percentage of the money or the work, we release the money after the fact. So that's how construction loans work. You're so far ahead of that investor in the beginning. They have all the fees and permits, all of the land up front in their cost, and then they start constructing. And so if something went wrong, it probably would be a very profitable thing to take over. Who uses hard money? Our investors do a number of different things. We have people that buy for cash flow and potential equity gains. And that's the history of California. Most of our gains historically have been because prices have gone up. In this latest few years, we've had the experience where we've had an opportunity for cash flow too, and that's not normal. I mean, this isn't Oklahoma, but it started feeling like it, to where you could buy something and have the cash flow be a big deal. And so that's been unusual for California, but we have investors that buy for that. We have investor flippers who buy below market and they fix it and they resell it right away. A lot of times it's the same person. We have investors that do some of both. So we have people that buy a property and maybe all of the things are available to them. In other words, this would cash flow. I could keep it. I bought it low enough to where I can resell it right away for a profit. And maybe somewhere during the project they change their mind and they decide, I'm going to keep this one. So that happens as well. We have people that start from scratch and they build homes. Sometimes they'll build homes to resell them. Sometimes they're building their own inventory to keep and let it go up. So that's another niche. This is the one group that we don't loan to. And a lot of times people think that they're kind of surprised by that. You don't loan to owner-occupants. No. Think about, in this market, we charge 12.5% interest on our loans that are buy and sell. So if an owner-occupant came to me and needed to borrow money at 12.5%, what would be done with that money as soon as we gave it to them? It would go to solve yesterday's problems, I guarantee you. And now they have an additional payment on top of that, and they have just spent all their reserves solving yesterday's problems. The chances of us getting paid successfully on that loan is very different than the clientele that we have. We have a business owner that wants us to be their business lender, and they want to do it for a long time. And so that's why we just don't do owner-occupants. Also, there are rules in place now that make that loan very dangerous as far as the legalities of somebody coming back and saying, well, you knew I couldn't pay the payment, why did you do the loan? So the owner-occupant that has a free and clear house that can't prove they could make the payment is going to have very few loans to get starting January 10th of next year. They've changed the rules as far as who can invest in trust deeds. And there's a word called suitability. So it's not just do you have enough money? One of the rules is that none of the trust deeds you invest in can be more than 10% of your net worth, excluding your residence. And so if you have a $3 million net worth, excluding your residence, you really have a maximum of $300,000 on a trust deed. You can do multiple $300,000 trust deeds, but you can't do an $800,000 loan. So that's a change. Now, what also we can't do as investors, let's say we have a widow come in and say, okay, my husband passed away and I have $6 million to invest. And we say, okay, Do you know what a trust deed is? Haven't got the foggiest idea. Oh, I said, and so can we say, well, that's okay, we'll take care of you, we'll put all your money in trust deeds and it'll work out great? No, I can't do that because that person isn't suitable for this investment. They haven't got a clue. They don't really know what it means to be a lender, and so I can't invest their money. And so that's a change as well. We can't be careless about investing 100% of somebody's net worth in trust deeds. We can't even take a dime of somebody that really doesn't understand what it is we do. And we have to be careful that each loan isn't over a certain percentage, because guess what? We're going to have an auditor someday come into the office and say, we'd like to take a look at your stuff. That's going to happen. Now, we've had the DRE come into our office and take a look at our stuff. And when they left, they said, you guys actually could teach a course on how to do this correctly. And so we're going to follow this rule too. And it's important that you realize that change has made opportunity for people that have wealth, because there's a lot of people that used to be in trust deeds that no longer can participate. As prices go up in California, what's the odds of you having a $50,000 trust deed where you alone are going to own the property and own the trust deed by yourself? You have to have a $500,000 net worth and the $50,000 trust deed. You'd have to be in an area like Lancaster or something. I said that for Tony Alvarez's benefit. In the booklet that the audience was given, it's on page 25 and 26. Literally, before we can let you fund a trust deed, we have to have you fill that out. Here's some more examples. There you go. Lancaster, $52,000 loan on an $87,000 house. The appropriate landscaping. $1,000 rent. And the payment on this is incorrect. The payment is not $1,200. I guarantee you that. So we have to make a slide change on that. Payment on that, if that's a rental, it is probably $480, something like that. Now, this is a very different type of house. This is a trust deed that pays 11%. It's a buy and sell. It's in Orange County. And this home is worth $1,222,000. We did an $800,000, or right in process right now, doing an $800,000 loan on that with a $7,000 a month payment. You'd have to have an $8 million net worth to take the trust deed. Actually, this trust deed is very desirable. Look at that house in an area of $1.2 million. So once again, oh gosh, I have to foreclose on that house. That wouldn't be a financial hardship. But the truth is, what's going to happen is somebody's going to get $7,000 a month until this person resells the property. And that's what's going to happen. Obviously, we checked out who's going to borrow that money. They have a history of paying. The other thing is, we would not take a flyer. This would not be a first loan we would do for anybody. So Craig Hill and the underwriting that we've created, we would not just toss out $800,000 to somebody we hadn't dealt with before. So that's important for you guys to realize, and it's something you can't see, but behind the scenes, we say no to a lot of people. And that's kind of the idea of having a broker involved, and we'll talk about that in a minute, is that there's a backstop with our experience to say yes to some and no to others. This is a property in San Bernardino, a 320 value, 195 loan at about 61% of value. Again, the payment to the investor is $1,950. This home, I don't have the rent. I don't even know if it's just a single family. It looks like it probably is 4-bedroom, 2-bath. This is in decent shape. The property has over $120,000 of equity. So again, if you had to take it over, I don't think it'd be bad. Why you work with a broker? Paperwork is constantly changing. Record keeping, payment collecting, monitoring not just that loan, but what else is going on in that investor's life. We see so many people think, okay, well, this is just really easy. I'll do it on my own. It is not. Some of the people know an investment club owner named Jack Fullerton, and I really like Jack Fullerton. Jack Fullerton invested in trust deeds at exactly the wrong market in the 90s, and he had to literally foreclose on every one of them because he did the wrong trust deeds to the wrong people. So even if you're very knowledgeable, it's not that easy. And so having a broker that has a clientele with a history of paying and knowledge of what they do is real important. We are funding 35 plus loans a month. We hear about twice that many or 3 times that many a month. So our company's become a deal magnet. And so we hear about all kinds of deals that you would never be in the loop of. Most people that are buying and selling properties, that's what they do. They don't usually chase around trying to borrow money directly from people. What they're doing is trying to find the next wholesale deal. And that's how they spend their time. Sometimes the people that find you, if you want to fund them a loan, have been told no by every lender that's in the business, and now you think it's a safe loan to make, and you're about to find out why maybe everyone said no. So there's no reason not to use a broker. The other thing about being a broker, it's an odd situation that usually we think, okay, when I'm selling a piece of property, if I list my home with a broker, it costs me extra money. A loan broker actually allows you to make a higher yield. There's a thing called usury. And when you go through a broker to fund loans and you are the funding source, you have the money, we can charge a higher interest rate legally than you could on your own. And so that allows you to collect a higher interest on your trust deeds than you would have otherwise. We do a lot of screening, not just of the borrower, but of the property, of their past. We have experienced people looking at the property. Every so often, at least once, probably every 2 months, during that process, we see something in the property that we don't like. We tell them, not only aren't we going to fund the loan, we suggest you don't buy the house. Sometimes the cheapest exit is lose your deposit, but you don't want to touch that. What you thought was a fixer-upper is really a knockdown, a teardown, so you have to be very careful about that. If you're going to get into the trust deed investments, you've got a fair amount of companies that do that. One of the advantages is that we have is that we're only in a California market. Our background is really as an investor. So when you're investing in a trust deed and you're on real property and something goes wrong, it's good to have the broker also have knowledge about the product you're lending on. So we've gone through several thousand homes in our career. We have fixed almost everything you could possibly imagine on a house, including raising it off of the ground to fix foundations on an old house built in the 1800s. So we've seen it all. We have the contractors. If there is a problem, it's not just handed over to you. Hey, I wish you well. We'll see you later. We have a team that's ready to deal with that. It happens so little. It's almost not worth mentioning, except for you probably need to know that that's available. But probably the most important thing is we have our ear to the ground as far as trends. And so I feel very comfortable saying that we've got some years ahead of us that are going to be very positive price-wise. And so when you're a lender, it'd be real important to know that you're not lending into a market that's likely to go down. Okay? This market is not likely to go down. It's likely to accelerate. It's going to make everything that we do in the loan business very safe for the next few years. Inside of the company, there's a lot of experience. Craig Hill has been in the loan business. I was his biggest borrower when he worked with another company. And our staff has been in the business, a lot of them over 25 years. Here's why that's important. There's certain types of loans that you just don't do. And when I owned the company, I remember listening to Craig talk to people when he was in the office next to me. And I heard him explain things over and over and over again. And somebody asked me one time, and I said, well, I can tell you, I can answer every question just the way Craig would. It's just that he knows that's why that's the answer. Because he's been through this. So why don't you loan on that? Well, because it could have a soil contamination problem because it's next to, okay, didn't know that. And so there's always things that we're careful with. And there's going to be something that Karin's going to bring up today, and it's called fraud. And we're very good at looking at a sequential deed transfer that gives us a scare. And so we don't like seeing quitclaim deeds from elderly people to their sibling, their kids, and then a refi. or we go, wait a minute, and we try to get to the bottom of that. Usually the bottom of that is that transfer wasn't legit. You would not know that. So there's all kinds of shenanigans that can go on, so you got to be very careful, okay? We have a business that's known for our integrity, and that's why you're here. And a lot of people here are here because of referrals of the way we do business. Our relationships, what's nice about our business model, it's really going to be hard to get rid of us, by the way. We teach you how to do the business, and you do the business successfully, you make a whole bunch of money, and then eventually what's going to happen is you're going to put your money in our trust deeds. So you're really going to be with us for a long time. And because of our experience, we can stick through any process with you, and we're doing the same thing you are. We're investing in trust deeds. We're investing in properties. This is a space we've landed on with our own money, and so it's the most comfortable thing for us. The other thing is we always deal in only first trust deeds. So we don't do junior liens, and once again, that's from experience. Sometimes you can say, well, gosh, the equity's there, it's a safe loan. Okay, yeah, but experience tells us as soon as we get into junior position, it's where problems start to occur, and now we have to solve a problem we really weren't excited about. So we just try to be careful and say, let's don't do that. Again, I'm really excited today because we have such a nice group of people here, but we also have very, very smart people that are going to talk to you. I've learned every time I've listened, and it's helped me plan what I needed to do for my family. So most of us here are involved in real estate, and we think, gosh, everybody does that. But the truth is, when Karn gets up here, very few assets in people's IRAs and so forth are in real estate. They're in all kinds of other worlds with much higher risk and much lower yields. So this is a special group. And so I feel like I'm so glad that I understand this business to where I can have the trust deeds and I can have rentals and I get it and I feel like I'm in control. That's the one thing all of us want to feel, is that we're in control, and if something goes wrong, we actually can control the outcome. That's my favorite thing about the investments that we have available. And I got to say, I'm very proud of our clientele that are the borrowers, because they allow me to stand up here and say, this is a very safe investment, that our clients pay their payments. I was very lucky to be able to present in front of Fannie Mae in Washington, D.C. I went there to try and get financing for investors. And while I was standing there, Aaron made a green circle. And the reason it was green was every loan that we had was current. And so here we are, we funded tens of millions of dollars at 12.5% interest, and every loan payment is made and it's current. And you should have seen their faces. Here they are in trouble and they're loaning at 4%, so they couldn't get it. Well, you're loaning to the wrong people. So we've chosen to loan to investors. It's been our world for a long time. And so thank you very much for your time this morning. Thank you.